In early 2020, the world was going about its business. Earnings calls focused on tariffs, growth forecasts, and the usual guidance games. Traders watched the United States, China trade truce, and the Fed's balance sheet. The coronavirus existed mostly as a headline about a cluster of pneumonia cases in Wuhan. Markets shrugged and made new highs. Then the virus left China, crossed borders, and turned into a global pandemic. In a few terrifying weeks, Wall Street went from record peaks to the fastest bear market in modern history. The setup mattered. The preceding decade had taught investors that central banks could backstop almost anything. After the 2008 crisis, the Fed had used zero rates and quantitative easing to nurse markets back to health. Every dip in the 2010s was bought because policy was supportive. By late 2019, unemployment was near 50-year lows, inflation was tame, and risk appetite was strong. Equities were expensive but supported by low rates and abundant liquidity. That confidence would be a liability when the shock arrived. Signals flashed early. In January 2020, epidemiologists warned of sustained human-to-human transmission. By February, Italy imposed lockdowns in Lombardy, and outbreaks appeared in South Korea, Iran, and the U.S. Yet stocks still hovered near highs. The market's problem was not whether a virus existed, but how to price simultaneous shocks: a sudden stop in global mobility, a collapse in services consumption, fractured supply chains, and the uncertainty of exponential spread. Models built on normal recessions were useless. When the repricing began, it was violent. In late February and March, the S&P 500 fell more than 30% in about a month. Multiple limit-down halts hit U.S. equity futures. Intraday swings rivaled the worst days of 2008. Volatility exploded. The VIX spiked above levels touched during the financial crisis. High-grade credit spreads blew out. Even safe assets gyrated as funds sold what they could, not what they wanted, to meet margin calls. Exchange-traded funds and bonds traded at steep discounts to net asset value. The machine that atomizes risk and distributes it across balance sheets went into reverse. Liquidity vanished where it was most expected. Oil added fuel. In early March, production talks between OPEC and Russia collapsed, launching a price war into a demand shock. Crude cratered. At one point, a U.S. futures contract settled below zero as storage filled and financial participants scrambled to exit expiring positions. Energy credit cracked. The shock was no longer just a pandemic. It was a synchronized demand implosion, a commodity shock, and a plumbing failure in financial markets. The policy response had to be bigger and faster than anything seen before. Central banks moved first. The Federal Reserve cut rates to zero between meetings, relaunched and then supersized quantitative easing by opening dollar swap lines with foreign central banks and rolled out facilities to stabilize money markets, commercial paper, asset-backed securities, municipal bonds, and corporate credit. For the first time, the Fed signaled willingness to purchase corporate bond ETFs and support fallen angels through special facilities. The goal was blunt: stop the dash for cash, restore two-way liquidity, and prevent a solvent but illiquid crisis from becoming a solvency spiral. Fiscal policy followed with unprecedented speed. In the U.S., Congress passed massive relief, including direct payments to households, expanded unemployment benefits, small business support, loans and guarantees, and targeted industry aid. Other countries rolled out furlough schemes, wage subsidies, tax deferrals, and bridge financing. The fiscal monetary mix intentionally over-delivered. Policymakers chose the risk of doing too much over too little. The speed and size of the intervention flipped market psychology from panic to survival mode. Markets bottomed before the economy. Economic data in March and April showed record declines in payrolls, retail sales, industrial production, and services activity. Yet equities rebounded sharply once policy backstops were credible and investors could imagine a bridge to the other side. technology and stay-at-home beneficiaries led. Cloud software, digital payments, e-commerce, and semiconductor leaders recovered first as investors discounted multi-year pull forward of digital adoption. Cyclicals and small caps lagged, then caught up when vaccines and reopening plans arrived. The pandemic did not just move prices, it rewired behavior. Work shifted remote. Consumers embraced delivery, telemedicine, streaming, curbside pickup, and contactless payments. Corporate capex tilted toward software, automation, cybersecurity, and supply chain resilience. Optionality on growth in digital infrastructure earned premium multiples. Old economy sectors had to justify balance sheet risk in a world of uncertain demand. The market began to price not just a recession and recovery, but a reordering of who would own future cash flows. The crash also revealed fault lines in market structure. ETF discounts in fixed income exposed how secondary market trading can deviate from underlying portfolios when dealers pull back balance sheet. Treasury volatility showed that even the deepest market depends on functioning intermediation. Basis trades and levered relative value positions unwound at once. Risk parity and volatility targeting strategies, built to adapt to changing risk, sold into falling markets and amplified moves. None of this was cause, but all of it shaped the path. Retail trading surged as lockdowns began and brokerages cut commissions to zero. Fractional shares and simple mobile interfaces lowered barriers. Stimulus checks and limited entertainment options funneled attention to markets. This was the seedbed for 2021's meme stock phenomenon. The line between investing and social media blurred, and narrative momentum became a tradable force. The pandemic was not only a macro shock, it was a cultural pivot for market participation. On the macro side, the pandemic reset inflation and policy for years. The initial collapse looked deflationary, but the combination of supply constraints, durable demand for goods, and aggressive policy created the conditions for an inflation surge as the economy reopened. Central banks later pivoted from maximum accommodation to the fastest tightening cycle in decades. The 2020 crash, the 2021 boom, and the 2022 tightening were different acts of the same play. Shock, stimulus, and normalization. Investors who understood the sequence could navigate rotations from long-duration tech to value and back as rates moved. Those who treated 2020 like 2008 missed the speed of the cycle. For long-only investors, the lesson was diversification and liquidity discipline. Cash is a cost in bull markets but priceless in forced deleveraging. For hedge funds, the lesson was correlation. In a true dash for cash, assets that should diversify can move together. For policymakers, the lesson was the importance of market plumbing. Facilities that seem obscure in quiet times become systemic in stress. And for everyone, the key lesson was humility. A biological shock humbled forecasts, models, and narratives in weeks. The endgame of the crash was not a linear recovery, but a barbell. Assets with clear secular tailwinds in a more digital, service-light economy were rewarded. At the same time, cyclical rebounds occurred when vaccines hit and mobility returned. The path was messy, with headline risk from variants, reopening hiccups, and supply chain snarls. But the market's core function, discount future cash flows under uncertainty, reasserted itself once policy built a bridge. The COVID crash compressed a decade of market education into a season. It taught speed. Bears can form in weeks and end in days. It taught size. Policy can overwhelm private flows when used decisively. It taught structure. Liquidity is a design choice, not a given. And it taught investors to separate solvency from liquidity, macro from micro, and temporary from permanent change. For Wall Street history, 2020 stands with 1929, 1987, and 2008. Not because it was the same, but because it forced lasting change. Circuit breakers worked as designed. The Fed's toolkit expanded. Fiscal policy proved it could move at scale. The investor base broadened through technology, and the line between real economy shock and market response became shorter than anyone expected. The fastest bear market in history was also among the fastest recoveries because policy, technology, and narrative aligned. There will be future crises. Some will echo the past, others will come from places we are not watching. The point of studying 2020 is not to memorize the headlines, but to internalize the mechanics, how shock turns into liquidity stress, how policy becomes a catalyst, how positioning amplifies moves, and how new regimes are born. The next time screens flash red, the memory of 2020 will shape decisions: when to de-risk, when to buy, and how to build portfolios that survive the gap between fear and fundamentals. In the end, the COVID-19 market crash was not just about falling prices. It was about the system proving that it could bend without breaking, given enough speed and force from institutions designed for emergencies. The lesson is simple and hard at once. Prepare in peace for what you cannot design in war. Markets reward that discipline. History records who had it.